can I record it from my end or?
I'm also recording, and also I have given you the approval to record in your system.
Yeah, it's recording right now.
Mm. Okay, can we start now? Mohanad?
Yes, yes.
Yeah, can we start now?
Sorry, yeah, I'm ready. I think you should start it from your end, right?
Yeah,
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 I'm
very good, yeah.
I'm totally here we go. Okay.
Yeah. Good evening, everyone. Welcome to the exclusive webinar, part of the lead up to 8th edition Forex Expo Dubai 2025. We are just a few months away from the premier global trading and fintech event. On October 6th and 7th, the Dubai World Trade Center will be the gathering point for professionals across the trading and financial services industry. Forex Expo Dubai 2025 brings together traders, brokers, investors, fintech innovators, and service providers from around the world. So tonight's session is brought to you in partnership with Q Prime, founded in 2015. Q Prime is a leading global fintech and award-winning CFD broker offering a wide range of products, low spreads, and top-tier execution to empower traders worldwide. With a presence in over 120 countries, Pru Prime is dedicated to innovation, security, and client success. So let's welcome our speaker, today's speaker, Mohanat Yaqub, Chief Market Analyst at Pru Prime, holds the CISA International Certificate in Wealth and Investment Management, CFT and CMT Level 2, and is recognized for his expert market insights and global media commentary. So tonight's topic is price momentum explained, a key edge in today's markets. So a few quick reminders before we begin. Feel free to drop your question in the live chat, and we will try to address those questions as much possible as during the Q&A session after the presentation. And this session is recorded, so you will be able to revisit the insights anytime. So over to you, Mohanad.
Thank you so much, Ankita, and thank you to Dubai Forex Expo for presenting me with this opportunity to connect with traders and provide something really, really valuable. Thank you so much, everyone, for being here. My name is Mohanad Yaout, and I'm the Chief Markets Analyst at PU Prime. And today, don't think of this as an educational session, although it is very good education. But I have been in the markets for many, many years. I have been leading the market research departments across various brokers recently and currently at PU Prime. And what I'm going to show you today is part of my experience, something that I basically use on a daily basis in my analysis and in my personal trading. So I don't just give education for the sake of education, but I do my best to provide you with something that will be very, very beneficial for you in your trading and in your analysis. So I think we're going to spend like 60 minutes together today. It's, of course, divided into many parts, but I don't like to stress or focus so much on the theoretical side, and I will, of course, move on to the practical side. So what I'm going to explain right now about momentum, of course, it's really great. However, what's even greater is to see it, how to apply the markets and how to trade the markets using those really, really simple, however, really powerful insights and strategies that I personally use. And yeah, this is why I talk about momentum a lot. This is not the first time I'm presenting this webinar. I've been doing it maybe for 6 or 7 times. And part of why I keep on doing this same webinar again and again is because simply after I do it, traders come back to me and say, yeah, we have learned a lot about momentum and now we can read price action more efficiently. So we want it again and again. No matter what trading strategy you use, whether you rely on classical chart patterns, whether you rely on Elliott waves, whatever it is, momentum is part of any trading strategy. If you understand momentum well, of course, you can apply it to your trading strategy. And I can say to you that it will definitely improve your win to loss ratio almost immediately just by understanding the key concepts of how prices move. So yeah, this is part of today. Just a moment. Okay, this is a brief personal introduction. As we said, my name is Mohamed Yaout, and I'm currently the Chief Markets Analyst at PU Prime. And basically, I started off as a technical analyst because at the end, yeah, with all the respect to the economy or the fundamental news and so on, but technical analysis is basically how you can trade markets, right? So I'm a certified financial technician by the International Federation of Technical Analysts, and I'm a level 2 chartered market technician. So I've quite spent a lot of time, learning and studying about technical analysis. And yeah, it's great. It's really great if you really understand how to use technical analysis. I don't care how long you have been in the markets, but one single tool can definitely help you if you do really understand how to use it. And this is why I'm here, only to talk about momentum. One simple tool, however, great and very useful if you do really understand how to use it in markets. So without further ado, let's dive into the definition of price momentum. Basically, whenever you open a chart, you will find the x-axis, which is down on the screen or on the chart, and the y-axis. So usually the x-axis is the date and time for the price movements, and the y-axis are usually the prices, right? So those are the two dimensions that you have on any chart, time and prices. However, there is always a third dimension that you never see, which is how prices move in relation to the time. So as time moves, prices also moves, right? This relationship between prices and time is what we call as momentum. It's the speed of how prices move. Because let's say I ask you today, what happened to gold price? You say, okay, gold price went higher. Did it go higher with $10 or did it go higher with $150? Right? Okay, it went higher in both cases, but the speed of how fast or slow prices moved in either direction, it's definitely important because it shows how much buying or selling interest there is behind the screen. So a $10 move in a 24-hour period is definitely not as powerful as a $100 move within the same 24-hour period. So this is why it's important to look at prices in relation to time. So this is price momentum. It basically refers to the rate at which the price of a financial asset, any financial asset, you can apply this to Forex, currencies, commodities, whether you trade crypto or anything. If you have prices and you have time, you definitely have this speed of how prices move as time goes by. So any financial asset and how it accelerates or deaccelerates over a given period. And notice that I didn't say move higher or lower, but I said accelerating or deaccelerating, right? Over a given period, it reflects the strength and speed of a price movement and is often used to identify the likelihood of trend continuation or potential reversals. Let's say I'm saying to you that, okay, gold prices went higher for the last 1 month, okay, which can happen sometimes. However, during the last 5 days, did gold prices really go higher with the same speed that it started with this month or not? Because comparing the speed is can tell you and can show you how prices are actually moving and whether they will continue moving in the same speed or not. Think of it as riding your car and going for, let's say, a 2 hour drive from one city to another. Your car doesn't start off this journey on 120 kilometers per hour, right? It's just there in your garage. You ride the car, you start it, and you start gaining speed. You are fastest during this journey when you are in the middle of the journey, which is on the highway itself, right? However, as you approach the destination or the city that you are going to, you will start, reducing your speed, and then you will reach your destination. This is how a car moves, You gain speed, you spend some time in this high speed or the highway, and then you start decelerating again because you are about to reach your destination. This is exactly how prices move. Of course, this is, a silly example, but it's exactly how prices move. Prices start a little bit slow, and during the middle of the trend, they gain speed and they gain momentum and they gain power because more people are jumping into this upward trend or downward trend or whatever. However, as it approaches a key destination, whether it's a support or a resistance level, you will see that people are losing interest in continuing this trend. And now you'll see that the speed of the price moves are getting lower and lower until you actually reach this destination, which is a resistance or support. So this is price momentum. It's really simple. The concept is really simple. How we can read it on the charts is definitely something we will also explain. But the concept itself, simple. It's just the speed of prices. So when momentum is strong, it often signals that more participants are entering in the direction of the trend. It's simple because what moves prices are basically supply and demand, right? If people go and buy a lot of Bitcoin, there is a lot of demand. People are buying with hundreds and thousands of dollars. Price will go higher with big amounts, right? Will go higher fast with power and strength because a lot of people are interested in buying. So you will just see that prices are jumping. There is momentum and there is power. And this is what you know when momentum is strong is that more participants are entering the direction of the trend, increasing the chances of continuation, right? On the other hand, weakening momentum, even if the price is still rising or falling, can be an early warning of exhaustion or a potential reversal, right? Uh, this is exactly what I want to explain to you today. When you see that prices are losing momentum, they are still going higher. Doesn't mean that prices are losing momentum, that they are losing or going lower. No, they are still moving higher. But the speed of how prices are moving in that upward trend, if it's weakening, it definitely means that demand is starting to weaken a little bit. And maybe this can mean a reversal. And this is really powerful if you combine it with other trading tools or technical tools like supply and demand, like support and resistance, like anything that you use. If you have areas of interest or prices of interest, as prices approach those levels, you should definitely watch the price momentum there. Okay. Why is momentum important? Just, a brief of what we explained so far. Momentum presents you with an early signal for trend continuation or reversal. If there's an upward trend and you see that momentum is good, there is power and there is strength, this is when you should follow the code that says your trend is your friend. But if you see that there is an upward trend, let's say, and the momentum is not so good, this is when you should know that maybe the trend is not your friend after all, or you should wait for early reversal hints or other confirmation, right? It helps confirm trade setups, and it's used by institutional traders for timing, right? There are many indicators that you can, watch for momentum. It's not only one, it's not only two, it's tens, or I wouldn't be, overstating this if I say hundreds of indicators. But once you understand the concept of momentum, you can apply this to literally any indicator that you watch. It's exactly like candlesticks, let's say. If you understand the concept of candlesticks, the Japanese candlesticks, and how they form and create and so on, you can use it to trade Forex, you can use it to trade indices, cryptos, whatever it is, right? So momentum is the same. It's a concept. You can apply it on any indicator. But those are the popular ones, and we will discuss a few of them. So we have the RSI, of course, it's a really popular momentum indicator. But today I'll not be explaining the normal RSI use, overbought and oversold. I'll give you some extra momentum tips. There's also the MACD histogram, which is the moving average convergence and divergence. And we will also explain the divergence, really good and really powerful. And the divergence is the only leading indicator there is in trading the financial markets. It will literally tell you how prices will move before they even move. And we will see this how. We also have the momentum oscillator, which is pretty straightforward. It measures momentum, so it's called momentum. We have the stochastic and we have the CCI, which is short for Commodity Channel Index. What we will be explaining today is just the RSI and the momentum along with the divergence. So a little bit of everything, but once you understand the concept, literally as soon as we finish this webinar, you can go ahead and apply the momentum concepts, let's say on stochastic or CCI. Although we'll never explain them, or we'll not be specifically explaining those indicators, but the same concept could be applied anywhere. Let's start with the momentum indicator, right? It's pretty forward. We're here to talk about momentum. So starting off with the one indicator, which is literally called momentum indicator. It's a technical tool that measures the speed of price changes over a specific period, right? Because speed, of course, is always related to time. Like the speed of your car. It goes 50 kilometers. Is it 50 kilometers per hour or 50 kilometers per day? So whenever you're looking at speed, you should know the speed within a specific period of time. Momentum indicator, it compares the current closing price to a past closing price, typically using a formula like this one. See, I'll tell you something really important. Is it important for you, or is it critical for you to look at those formulas and memorize them or whatever? No, it's not. Unless you want to become a really certified financial technician or someone who's, coding new indicators or trying to reach an edge in markets, an edge after an edge and so on, or you're, running a hedge fund of thousands of millions or billions of dollars or whatever, you shouldn't be really concerned with the formulas, right? So I wouldn't really focus on the formulas itself because I'm not here to overcomplicate things, but I will tell you exactly how to apply this. But to make it short for you, this is the formula for momentum, and it's really easy. It's just the current price minus a price, maybe N periods ago. N could be 1 day, could be 5 periods, and 5 periods means maybe 5 hours if you're on the hourly time frame. So it depends on the chart and the time frame itself. But simply, it's a current price minus a previous or old price, right? This calculation results in a line that fluctuates above and below a zero line, right? So we have a zero line, and the line of momentum goes above and beyond, helping traders identify whether the price is gaining or losing strength. When the momentum line is rising above zero, it suggests increasing bullish strength. So the line is going higher, momentum is powerful, there is increased bullish strength. When it's falling below zero, it indicates growing bearish pressure. People are selling. And of course, we'll look at this. A flattening momentum signals a possible loss of strength or market consolidation. So if the line is just moving in a sideways range, not moving higher and not moving lower, so it's indicating that prices are not doing anything. So I know the theoretical, speech is hard a little bit. However, this is the practical thing of sides of things. Okay, so this is a chart. I think that was for the pound Canadian. That was today, literally. And as you can see, this is the momentum line down there. And you can see it says 0, and the line is just moving above this line and below this line. So it measures the momentum, right? And this is exactly what I want you to look at for now. This is the momentum line, and it's just drawn using a current price minus previous price. When we have new prices, so we use those new prices and subtract old prices and so on, and the line keeps on moving. This is a momentum line, and it may seem okay, a lot of noise and a lot of signals there. I don't know whether I should buy or sell. However, wait for it and I'll explain how to properly read a similar line without any noise. Okay, just leave the momentum indicator for now and let's discuss the RSI indicator, and I'll show you how similar it is to the momentum. So the relative strength index, or the RSI, is very popular, and it's another momentum oscillator. And as the name says, it's the relative strength. Strength for what? It's the price strength, right? And relative to what? Relative to time. So it's really measuring the strength of prices moving higher or lower as time moves. So it's the power, or it's the speed of prices. Again, it's a momentum oscillator that measures the speed and magnitude of recent price changes to evaluate overbought or oversold conditions. What's the formula for this one? A little bit more complicated than the momentum, and I wouldn't really bother you by explaining, but it's out there. If you want to write it down, screenshot, you can definitely do this. But the RSI, it's a range. It provides you with a range. If the line of the RSI is above 70, the asset or the currency or the index you're trading or whatever it is, it's considered overbought. Okay? If the RSI is below 30, it's considered oversold, and the divergence between RSI and price can signal a weakening trend or upcoming reversal. This is really, really important. Now let's have a look on the RSI. I know now we have explained momentum a little bit and we left it there. We're now explaining RSI a little bit and we will leave it there, and then we will combine everything together by another concept that we will be explaining. So if you're feeling right now that, okay, maybe I'm not following enough, I think I'm not getting or understanding 100% of what he's trying to say, just stay on there and wait for me, because I've been doing this webinar for many, many times, and I know probably all of the questions you have right now, and I'll definitely answer them anyway. So the RSI indicator is down there between 30 and 70. There is a range, and the line is just moving higher and lower as prices move. This is another momentum indicator, and this is the RSI. Now let's have a look on both the RSI and momentum indicators together, right? And if you have a good eye for detail, you can start noticing that maybe they look so much similar, right? Even the small highs and lows formed. I don't want you to look at the price itself right now. Forget about the price. Just look down below on the indicators panel and look at the RSI, which is colored in purple, and the one below, which is in black. This is the momentum. You will start to see that maybe they are so much alike. Of course, not typical, but they are so similar to each other. And this is why I want to say that if you would be using momentum, it's not wise of you to use more than one momentum indicator and say, okay, if RSI is saying I should buy, momentum is saying I should buy, or other indicators are saying I should buy, so this is a powerful buy signal. It's not, because all of them, although they calculate momentum in different ways, but at the end, they are calculating momentum. So if prices, and this often happens, if prices are going all around the place, you can get false signals. And if you get false signal on one, most probably you'll get the same false signal on all of the other momentum indicators. And this is totally normal. So don't think that, okay, I have 7 momentum indicators that they're telling me I should buy. No, there are not 7 momentum indicators. It's just one momentum signal on 7 different indicators calculated differently. So this is why I gave you this slide with the RSI and momentum, because if you're gonna study RSI more deeply and use it, or momentum, or MACD, or CCI, or the other indicators we mentioned, just study one very well and use it. Don't, overcomplicate things and get this false confidence that I have all of the signals on my side. Believe me, you don't have any, right? Now, what is momentum divergence? Because this is how you would be trading on those, charts and lines down there. Momentum divergence, I've been using it in my personal trading strategy for around 5 years. And believe me when I say I cannot trade without the divergence. Literally, I cannot trade the markets without divergence. Yeah, I can try to trade. I can try to understand what's happening in prices. But if I don't have momentum, and as a result of this, I don't have a divergence on momentum, sometimes I'll just say, okay, I don't know what prices are doing. What is momentum divergence? The divergence occurs when the price of an asset, right, moves in one direction. So let's say the price is moving higher. This is one direction, and moving lower. But a momentum indicator that you're having below the chart or below the price, like the RSI, like the MACD, or the momentum, or the CCI, or the stochastic, or whatever the momentum indicator that you use, moves in the opposite direction. Opposite direction to what? To price. So when you have prices moving higher, let's say, and momentum is not moving higher, this is a divergence. This is a discrepancy between the behavior of prices and the behavior of momentum. Or on the other hand, if prices are moving lower, but you can see momentum moving higher, this is another way to see divergence, right? Divergence is the only technical tool in any technical analysis way or method that is a leading price indicator. It comes before the actual price move, right? Most of the indicators, or not most, 99% of indicators out there, they are lagging indicators, right? Because they are calculated based on what's happening on the price. So they need prices to move, and those price moves are then calculated in some way, and then it gives you a signal. So there is a bit of lag, right? You need prices to move some, upward moves first before the indicator will tell, okay, this is now a buy signal. Habibi, it's already went up already. So it's a lagging, and indicators generally are lagging. However, when you actually watch for the divergence on momentum, the divergence is the only leading concept in any technical analysis way, right? What's a bullish divergence? Bullish divergence, bullish, the word bullish means buying, means that we are expecting this to move higher. So the bullish divergence is when basically prices are moving lower, but the momentum is moving higher lows. So this is a potential trend upward. This is telling you that prices will be moving higher, and the bearish divergence is the other way around. If you have an upward trend, prices are moving higher, but the momentum is moving lower. Let's see that on the chart. This is a bullish divergence. So this is a very, very basic, I just draw it on my on the presentation itself, but we'll definitely look at the price moves, actual price moves. But just to make it very simple for you, this is the bullish divergence. So the upper side here, let me see if I can annotate this. Right, I can't. So the upper side here, this is price. Okay. And the lower side, think of this as any momentum indicator that we mentioned, whether it's RSI, momentum, or others, because this concept can be applied to any momentum indicator. So if prices are moving lower, this is a low, this is a high, this is a lower low, this is a lower high, lower low, and so on. So prices are moving lower, right? But when you check momentum, although prices are forming lower lows, momentum is moving higher and registering a higher low. This is when you should stop and say, wait a minute, prices are moving lower, and if prices are moving lower, momentum or this indicator should move lower. However, I can see that prices are moving lower, but momentum is moving higher. This is a bullish divergence. And this will tell you that, okay, maybe prices will go higher after all. Instead of moving lower, momentum says we are moving higher. So it's a bullish entry here, of course, with other supply and demand or anything else that you use, okay? This is the bearish divergence, and this is the exact opposite of what we have just explained. Those are price moves. This is a high, this is a low, this is a higher high, this is a higher low, this is a higher high, and so on and so forth. So prices are moving higher. However, momentum is moving lower. So this is a high on momentum, but the next one is a lower high. So prices are moving high, making higher highs are moving higher, but momentum is moving lower. Right? Let me delete this. And now let's have a look on examples of divergence. This is an example of divergence. Again, this is the dollar index, and this is literally the latest chart. So I'm not giving you really old examples that are found on Google or the perfect examples. I just accessed my chart, and I've just it was there. You know, this is probably the 24th of June. That was yesterday. So starting yesterday, the dollar index started moving higher, and even throughout trading sessions today. And I knew that most probably the dollar will move higher because on my momentum indicators, I had this. What's this? It's simply that the dollar index was basically moving lower. So that's a low here, and that's a lower low. So prices were still moving low. However, at the same time, that's a low here on momentum, and momentum started moving higher. So we started moving higher on price. So literally, if we were back in time here, prices didn't even start moving higher yet. Prices were still moving lower up to that point. But momentum was moving higher, and it came before the actual price move. And this is what I'm saying. This is a leading price indicator. It leads price. It comes actually before the price move, right? So again, let me clear it. If we are here in time, don't think this is so accurate drawing. Wait a minute. It's really good. Again, sorry. Okay. If we are here in time, prices are still moving lower. We didn't move higher yet, but momentum was already starting to move higher, and eventually prices followed what momentum said, right? This is only one example. Can we have another example? Sure, let's do it. This is two examples on the chart for the pound versus the dollar literally today. So I think that was a couple of hours ago, maybe 3-4 hours. I was, having those screenshots. So this is the latest price moves on the pound. And whenever I access, by the way, sorry, I forgot to say that the previous slide, this is the RSI indicator. You already explained a little bit about it, right? But this is now that we are applying the momentum divergence on RSI. on this slide, I got you another momentum indicator. I think this one, yeah, this is momentum. We already explained momentum. So there is a zero line here, right? This is the zero and prices are just moving above and below the zero line. So it's another momentum indicator completely, another chart, but again, we can still apply the same concept. Which one should we start with? Let me start with this one. What happened here is that prices were moving higher, right? This is the last higher high, slightly above the previous one. So up to this point, prices were still moving higher. What you can see on momentum indicator here, I don't really care about the small highs and lows. I'm just looking for divergence. Is the behavior of the momentum indicator down there following price? It's not, because prices are moving higher. It started off, yes, it was moving higher with price, and then it moved sideways a little bit, and then it started moving lower. So it started moving lower before prices went lower, and then prices followed, and we went way lower, right? On the same chart, when we started moving lower, there is a change in direction here, right? Could have momentum saw this coming before it came? Yes, definitely, because yeah, the upward move started here. So let's divide this here and see what's happening. Prices were moving lower. This is a low before this one. So yeah, prices are moving lower. Momentum said, no, sorry, I'm going higher. Price said, okay, let's go higher. So momentum is not momentum. Divergence on momentum indicators actually come a lot before the actual price moves, right? Do we have another examples? Yes. This, the one down here, this is a third indicator. So we discussed RSI, we discussed momentum. This is the CCI. We didn't explain the CCI indicator specifically, but we can apply the momentum divergence on this because at the end, CCI, as we mentioned at the beginning of the webinar, it's a momentum indicator. So any momentum indicator can apply or can follow this momentum and the divergence concept. And yeah, this is gold price again today, probably 4 hours ago when I was again, preparing this webinar, prices were moving lower. Okay. What happened here is that yesterday prices started to move a little bit higher, but before prices went higher, it was moving lower, but momentum was moving higher before prices. So you can see here, prices are still moving way lower, by the way. This is a lower low than the previous one, a much lower low. But momentum here was forming slightly higher low. So when you see that there is a difference in behavior between price moves and momentum moves, you definitely should know that, okay, wait, something is going wrong and we should think of this, right? I don't think we do have any further examples. And yeah, let me share my screen, other screen. Wait a minute, please. How can I get a new share screen? And I'll have to stop the share and share one more time, right? Share. I need to get my trading view. Here we go.
Yeah.
And yes, now you can see my screen. Now you can see, yeah, basically this is just live practice. And Yeah, if you want any specific pair that we should look at, it's really quick. It really like just 5 minutes or so. But we want to see if this actually happens in the real market analysis or not. And let's have a look on CCI, Commodity Channel Index. This is an indicator that we didn't explain specifically, but yeah, you can see gold. This is what I have on my chart right now. Do you see this huge downward trend here from 3,450 down to 3,300? So we are talking about $150 downward trend or 1,500 pips. You can see before this downward trend happened, prices were moving higher. It started off slow momentum, then started moving higher with a bigger speed, and then this is what happened. Now I want you to focus on this high. I think I can, yeah, use my zoom a little bit. This is a high, slightly higher than the previous one. So prices are still moving bullish. In this case, people might say, if they don't watch momentum, they will say, okay, prices are moving higher, probably due to geopolitical tensions and so on. And yeah, you should buy. If, however, you look at momentum down there, you will see that, okay, although prices are moving higher, momentum is moving lower. And this is exactly what you get, a downward move, just to follow momentum. Now, I don't want you to get confused or believe, because yeah, I'm probably showing you very good examples on my chart. I don't want you to believe. I'm not here to overpromise you that, okay, this is the only technical tool that you need. No, I'm saying you definitely need momentum. You definitely should use it, but of course, use it with other tools. I definitely use it with supply and demand. Okay, only supply and demand. So if there's a supply zone here and you have weak momentum, then you have this downward move. Let me have another look literally on any indicator or any. Let's have a look on indices. Let me have a look on the indices here. Yep, an upward move like this one. Momentum was definitely moving higher, although prices are moving. So we have this low here, and we have this equal low. So prices are just moving with equal lows, but momentum was moving higher. So we had this powerful upward move. What else? Let me have a look on currencies. Maybe we can have a last example before going for questions. Wow, that's a really, really good example here on the dollar versus the Swiss franc. This is a low, lower low. This is momentum moving higher. So we started moving higher a little bit. And yeah, how much? Around 30 pips. Just because momentum said, okay, we cannot continue moving lower. We should move higher or something. Again, this is exactly good example here. You see this huge upward move after a powerful downward move. Momentum saw it coming before. So if we were here before this move happened, prices are moving very, very powerful trend lower. But momentum somehow, because it does the magic, it said, okay, I cannot move lower. Prices are, the momentum is moving higher, and then you get this powerful move higher. Even before this ended and moved lower again, you can see how it gives, both ways. Upward trend, when it ends, gives you a downward trend and so on. So this upward trend was moving higher, but momentum here was moving lower, right? This is a high, lower high. Not sure. Hopefully this is clear on your screen, but prices were moving higher. This said, okay, I cannot continue, and prices started moving lower. again, as I told you, it's really powerful when you mix it with a supply and demand zone. So this is definitely a supply zone here with this gap. Went higher, supply, weak momentum, sell. And this is how you get it. So simple, nothing, it's really a simple concept. Of course, I do expect that you will need some time for your eyes to be trained in order to get this pattern again and again happening in markets. You need more practice, of course, because something I've learned in years cannot fully give you the full my experience in 1 hour. But I'm telling you, it's really powerful. I'm trying to teach you the concepts and the basics, and go ahead, read more about momentum, and try to see it yourself on the chart. And this is how you'll basically be mastering the momentum. Personally, because yeah, I'm here to talk about my personal experience and try to give you the most. I do have this squeeze momentum indicator. It's another momentum indicator. It's called the squeeze, and it's just a histogram. And again, it's really powerful. It's not really you wouldn't find a big difference, but personally, I visualize it more. Again, this is a lower high. Prices are moving lower. Let me get you another chart. Literally any chart. Wow. That's the euro versus the Australian. You can see this powerful move higher. Why didn't we continue? Because prices were moving higher, but momentum was slightly moving in a sideways and started moving lower before prices went lower, So it was here, momentum started moving lower before even prices reversed. And then we had this, how many? Almost 150 pips on the Euro Australian. And before this upward move, we have checked this reversal here, and momentum saw it coming. How about this reversal here? Did momentum see it coming? Yes, it definitely did. Momentum is moving higher, although prices were moving a little lower. So lower lows and lower highs. That was the recent low. Lower low here. Here you can see, it's not following. Momentum is moving a little bit higher. So you have this here. Again, before this, can we see this reversal? Did momentum see it coming? Yes, it did. Higher high, but prices are saying, sorry, I cannot. Boom, you have it. Again, here, I cannot stress enough how powerful it is in, reading this. Prices were moving lower. Momentum is moving higher. Literally, guys, those examples I'm giving you right now, it's just there. You can say, or you can ask for any chart, and I can grab it open for you, because some people sometimes, because it's really powerful, they say, okay, you're just preparing those examples before the webinar. What would I be, winning from this? I'm just here to provide you with my personal experience and how powerful it is. Again, before this downward move, right? Slightly higher high, but momentum was not there. And so on and so forth. I don't want, to repeat it again and again, but it's really powerful for the trends. Big moves. Something like when you zoom out and see this, you will definitely see momentum reading those moves before it happens, but not specifically on the short time frames. Not specifically, because this is not a reversal, this is a correction, right? This is a correction as well, and so on. So they are great for the big moves. And as like any other technical indicator or tool out there, the more you use it on bigger time frames, the more quality signals you get out of it, not actually false signals, right? Here, and literally this is what's happening now. Literally live trading on the euro versus the Australian dollar. You can see prices are moving a little bit higher, a little bit. Is momentum following? It's not. So this is basically a resistance level here. So we moved lower, touched it, another touch, momentum says, okay, there is no power in this upward move. I'm moving lower. So probably the Euro Australian will move lower literally from here. This is not an investment advice. This is just literally applying what we just explained. And yeah, it makes sense to move lower because even Fibonacci is moving lower. It's 50% Fibonacci. So yeah, it's a perfect trading opportunity just because you are lucky, guys. Just because you guys right now here are lucky because we have seen this happening. How to understand the trades about the wars? Not entirely sure. Okay, by the way, I'm done. Uh, let me just share my screen again for this one. Okay, now you can see this one. And yeah, let's have some questions. If you have any questions, please just leave it in the comment section. I'm sorry, Andres, I'm not entirely sure I understand your question. How to understand the trades about the wars? What do you mean? What's the trades? Can you please write it down again? And if any of you have any other questions, please let me know before we end the session here. How do I avoid false signals? Experience and not working with any one indicator. And this is why I told you, this is not the holy grail of trading. And if you rely on momentum indicators alone to trade, you will get false signals. And unless if you want to use it alone and get false signals and you're happy with that, you will have to have a very powerful risk management strategy to win more than you lose. So it's a combination of things. But if you don't want to rely on it alone or you want to avoid false signals, you can probably use it with other indicators or other technical tools. As I say, I personally use it with supply and demand. What are the chances that prices are near resistance or supply zone and momentum, as we explained and showed you, is showing that prices most probably will move lower? What are the chances that prices will continue to move high? Yeah, of course, it's a probability. It's out there. Prices can literally do anything at any point of time, but it's a low chance, right? Because not only now you're trading near supply, but you're not only trading with weak momentum concepts, but you're trading with both. So adding more filters, like I would say, will will reduce false signals. You can never avoid false signals in markets. You can never. If I told you I personally avoid false signals, so I'll be a scammer and a liar because I lose trades. It's definitely okay for you if you take 10 trades to lose seven. I'm sorry, to lose 3 out of 10 and win 7. So this is the healthy win to loss ratio, but you will definitely lose, especially in those times when we have Donald Trump, when we have wars and uncertainty and so on. So you can reduce false signals by practice, by using this indicator with other tools, by experience, but you can never avoid them. How does news on war impact trade decision according to you? I don't, with all my respect. Okay, I'm a chief markets analyst, so I send daily basis. I send reports to our clients, including fundamental analysis and technical analysis. But when I actually trade, I use technical analysis with stop loss and a decent risk to reward ratio. And I don't care what happens because you can literally, at the moment, you cannot expect what will happen tomorrow. Literally, from one day you had, chances of World War III happening, and then after 12 days, everything is back to normal and everything is okay. We are friends, and there is a ceasefire and so on. So when it comes to politics and geopolitics and wars and so on, especially with Donald Trump in the White House, you can't literally expect what you can have for dinner tonight. So if you will just, leave trading because you cannot expect what's going to happen, you will not trade. So my opinion is, yeah, do your best, do your research, use your technical analysis, and unless you're trading on very long time frames, like I would say daily, the weekly time frames, and so on, I wouldn't personally care about what's happening. Yeah, I care about it for my own knowledge and for my clients' knowledge, to position long-term investments and so on. But on the short term, if you're trading the 1 hour and the 4 hour time frame, well, how could you know what will happen in the next 4, 8 hours, 12 hours fundamentally? You cannot. You cannot. Unless Donald Trump is asleep, you literally cannot. So do your research, stick to your risk management strategy, use a stop loss, never trade without a stop loss, trade with amounts that you can and you can afford to lose, and you're good to go. This is the basic 101, of risk management. There's nothing else but trying to expect, never do it. I think I'm done, and I think we don't have any other questions.
Yes, so a big thank you to you, Mohanat, for sharing your expertise on price momentum strategies this evening. So, if you found today's session valuable, there is much more to explore at Forex Expo Dubai 2025. So, don't miss the chance to visit the PU Prime booth at the Dubai World Trade Center on October 6th and 7th. So, if you haven't registered yet, please go to our website, Forex Expo Dubai, and register yourself. Thank you for joining us, and we look forward to seeing you at our next webinar. Thank you so much.
Thank you so much, Ankita. Have a good day, guys.
Yeah,
Thank you.
thank you.